All right, so what is an order block? An order block is essentially the last up candle before the major down move or the last down candle before a major up move. Now, I know to some of you, or maybe most of you, that may not make sense, so I'll break it down a bit. Okay, so have you ever been in a situation where the markets do this? And all of a sudden, the market makes a strong, fast move breaking structure, like this. And it can be multiple structures as well. It doesn't have to be just one area of structure that breaks. It could be multiple. Okay, and then the same thing goes for an uptrend, like this. So what an order block is, it's the last down candle before this major move that goes up like this, and the last up candle before this major move goes down like this. That's what an order block is. Now, I'll break it down to simplify it a bit more for those that aren't quite clear with it. Okay, so when we're going on a downtrend, right, and the market just breaks structure like crazy, just breaks the structure so fast that a lot of us buyers that want to buy here don't have enough time to buy. So this right here will be our last down candle before this huge move that broke all the structure. And let's change this to something else. Maybe orange. Okay, so this will be the last down candle before this major up move happens. And what we're expecting is for the market to come back here to mitigate before we can take a buy here. Okay, so why do these crazy moves happen? You know, moves that are moving so fast like this, and like this especially, you know. Why do these happen, okay? Well, there's four main reasons why these huge moves happen like this. And it all has to do with the banks and institutions, okay? The banks and institutions have the money to push, the market any direction they want. And us retail traders, we can't do anything, right? We just simply follow or mimic what the direction is or what the market's trying to tell us. And we do what the markets are doing, right? We go towards where liquidity is and stuff like that. So there's four main reasons, right? The first main reason is the institutions who change the direction. They're changing the direction of the market, okay? And they have a huge purpose for that because, in order to in order for the market to move, right, they have to take out liquidity, which is sitting here, here, and here, right? Liquidity is everywhere. So in order for markets to move or make this huge push, what the markets are doing essentially, or what the institutions are doing, is they're going up. They're trying to take out every retail trader's money, all the sellers. In this case, all the sellers that sold here, and then they take all their money and then they push everybody down. So that's a change of direction, right? So that's number one. Number two is also what's called a liquidity grab. It's similar to a change of direction, but essentially when the market pushes up like this, right, they're taking out sellers here. And this is called a liquidity grab. All right. And again, when they take out the sellers, they're pushing the market vice versa, the other way around. And they take out your money. And the number three would be testing a new direction. So when the markets are pushing up like this, a lot of retail traders will assume, well, okay, there's a break of structure, there's a break of structure here, and now we're going to be looking for the test and then the buy. And this is also what's called a fake out. Okay, so banks pretty much, they push the market so fast going up like this to make retail traders think that you're going to be looking for buys. But in this case, they're actually taking out sellers to change the direction of the market to move it back down. All right, so that's number three. Number four, this one's very interesting. It's called filling out the imbalances. It's called an imbalance, pretty much. But the number four is really banks trying to recorrect imbalances. So what an imbalance is, very easy here. What an imbalance is the market is starting, if you see where the market pushes so fast, and there's an open area like this, this area in here is called the imbalance. And so what banks are doing is essentially when they push the market so fast that buyers had no time, a lot of retail traders like ourselves, had no time to react to buy with the banks. they're going to come back to fill out the gaps of these imbalances. Okay, so that's the fourth. That's the fourth thing that the banks do, and why they're why these crazy moves happen like this. So keep those in mind when you're when you're looking to trade. Okay, now let's get down to how to trade order blocks. Okay, so very easy. We always start when we start trading order blocks. We start on the higher time frame. In this case, our higher time frame is the daily time frame. Now, in order to see the direction, you can obviously see that the direction is pushing downwards. So our bias is a sell bias on this. We're looking for sells only. We're not looking for buys going up because that would be bad. So we always start on the daily, right? And what I typically do is when we're looking for order blocks, let's have this scenario, like this scenario, for example. Let's do this. So I would look when there's a huge push like this in the market. This tells me one thing. It doesn't tell me that the market's going to start changing direction, pushing up. What it tells me is that there was a huge move that was in the market like this. Now we have to find out where that order block is because we know that the market is pushing down, doing lower lows, right? So my instincts would be to say, okay, well, where is that last order block? Where's that last order block, right? And so once the market has given me a chance to break structure like this, now I can be comfortable enough to say to myself, okay, I'm looking for the last up candle before the down move happened. And where's that last up candle in here? Can you guys tell? Can you guys see? Well, obviously, I have it highlighted here. But as you know, an order block, obviously, the way we trade order blocks is you have to identify when it's an uptrend or when price is pushing up. It's the last up candle before this major move down happened. So in this case, this is the order block, right? So we highlight the order block and we put this line here that says, it's a break of structure. BOS stands for break of structure. And then what we're going to do is be very patient and wait for the market to come back to that order block eventually here and tap us in to take price down. Now, what I normally do here is I usually put like a line, something like this, like a notification, and to let me know, something like this, to let me know that when price gets there eventually. Oh, I can't put a notification, but because we're on replay. But normally, I would have put a notification bell here and wait for the market to retrace all the way back up here. And once it hits my notification, I'm going to scale down to the lower time frame and then start looking for the sells. Now, obviously, you don't have to stare at this chart the whole time. You can just leave it and then go about your day and wait until that notification hits. All right. So what we're going to do is we're going to be waiting for the market to come and hit this area here, like it just did here. Okay. And what we're going to do is once it hits this area, now we're going to go on a lower time frame. And in this case, lower time frame is my 1 hour. I mean, I can even go lower to I usually enter on the 1 minute, but since, we're on replay, I'm not able to go all the way down and scale down for the replay's sake because the market's going to tap me out or go back to the beginning. But okay, once it hits us here, okay, number one thing, what do we do here? We have to see that the breaking of structure is occurring here, okay? Because a lot of retail traders would do is they would just start, as soon as they hit their order blocks, they're going to put their, risk to reward tool here, right? And maybe do something dumb like this where they put the risk all the way to that high, right? And then put their reward tool down here. And, this is bad because right now you're sitting in a bad position. And what this means is that, there's no guarantee, no order block is guaranteed that price is going to be taken down, right? And this is why we have to be precautious. Now, a lot of people take it on the first trade, right? But what I like to do is wait for some structure to be broken to guarantee that the direction is going to be changing the market. And that, we are somewhat guaranteed and good to go to take the sell to hit our next target here. And another bad thing, why this is bad to look for sells here, or at least to start selling here, is because if you're entering here, you're giving the market a chance to go back up right here and you would suffer this big drawdown right here. And then who knows, you might be scared, emotions might come in play, and then you're like, oh shoot, okay, now I got to tap out and cut out of my cut out of my trade right there, right? And then what do you know? Market just starts pushing down, and you're like, oh shoot, I should have held on this trade, right? Another bad reason to take a trade right away up here at the order block is because obviously price can just go up and hit you out like this, and you're like, ah, shoot, But Bennett said, that we should wait for, the market to hit our order block and now start taking sells. Well, not necessarily, right? Because now when we're going in the lower time frame, look at the behavior in the market. It's pushing up. It's doing higher highs. Does this even tell us that we should be selling right now? I'm gonna give you guys a chance to answer this. No, right? Obviously not. Because when we're pushing higher highs, the market's telling us we're going on an upwards trend, not on a downwards trend. So in this case, this is why we wait for a second break of structure, at least some form break of structure, because it'll guarantee us the trade going down, right? So now here we go. We see a first break of structure here. Okay, and look what happened. You see, this is why we don't take sells right away. We wait for the market to give us the sign, which is breaking structure. Okay, so let's do this. We're going to recorrect our position here. Okay, this is our structure here, and also our structure here. There's structure in this area. All right, so what we're waiting for is for double breaks of structure. There's one form right there, right? And actually there's multiple, as you can see right here. We had 1 and 2 right here. Now what we're waiting for is for price to come and mitigate one of these order blocks so we can safely take a sell. Here I see an order block right here, right? And another order block right at this high, potentially right here. Okay, now let me explain this risk again. There's another thing I wanted to explain here. When you're taking a sell like this, especially from the higher time frame, and you're putting your risk this high, right? Look at the amount of pips you're risking. You're risking 83 pips, right? I mean, this is insane to me, right? The minimum I trade is at least, or risk, is about 5, maybe up to 10 pips of risk, and that's it, okay? And so this is why that's really bad. You're going to be suffering a huge drawdown when the market goes inside this area, and you're going to be hurting. So what we do is when we go on a lower time frame, we want to minimize our risk, okay, and minimize as much risk as possible so we can not lose that much, right? And the way we calculate risk is based off of the order block, like right here, just like that. Okay, now look at my risk. It's down to 9.5 pips. You see that, guys? 9.5 pips. So this I feel a lot more comfortable to take. And if I had to lose it, then I would lose it and I wouldn't be sour about it. So let's see what happens from here, okay? Price is going this way, right? It's coming over here. It's tapping the order block just about, almost. In fact, it kind of did, it almost sort of did. But in this case, it would count as I feel like it would count as a tapping an order block based off of this area right here. Yeah, right there. And then you just take the trade, right? And then now just wait patiently and target this low right here. Okay, and I'm going to tell you why you want to target this low. And the reason why you want to target this low down here is because a lot of traders, most traders, they want to target something that's astronomically crazy, which means, taking the reward and putting it, below this break of structure. Now, let me tell you guys why you shouldn't do that. The reason why you shouldn't put your reward, past this break of structure is because this area here is not guaranteed. It's not guaranteed for us to it's not guaranteed because obviously the markets can do whatever they want. The market can easily tap here at this break of structure area and then start shooting all the way back up. And then you're like, okay, well, I want to take my profit all the way down here, but I didn't. So the market started shooting up and now you're settling for this, right? So it's always good to have a destination in mind. And this destination in this case, our destination in this case is just next low, or in other cases, it would be the next high if you're looking for buys, right? So this is how we would do it, just like this. And if you look at this right here, look at the amount of the percentage right here that we have. It's 65.44, okay? Now, I don't know about you guys, but having 65%, in one whole entire trade is pretty good. It's really amazing, okay, to say the least, because a lot of the traders that we're taught, a lot of retail traders that are taught, you're taught to have, what, a 1.3, sorry, a 3.3% 3%, right? Something like this, and look at that just look at this, a big risk. You're risking 135 pips to get, 413, right? That's outrageous, and sometimes in other cases it would be probably, 5% or something, but something like that. Oops. Can't do my math here. 93 pips risk to get 460 pips. It's just insane to me. So this is how we trade. Okay, this is how we enter order blocks. When we're entering a trade up here, okay, there's a way to manage your trades. Okay, one form of management is obviously reducing the amount of risk that you have here when you're placing your risk to reward tool, right? But another way to do it, well, a lot of traders do it actually, is when they're looking for entries, some people would use a 50%. They would enter at the 50% of the order block, which means this. So we would measure the order block like this, and we would do this, right? So the 50% line is, you can see this little dotted line right here. That's the 50%. And they would put their risk tool right here, okay, and minimize their risk even more. So now we'd be risking what? Let me see, what we'd be risking 5.4 pips, right? But sometimes the market never comes that deep inside the order block and doesn't hit, and it wouldn't hit your sell stop or whatever. And what I like to do personally is to have to take sells right at the close, or sorry, the open of the order block. So when the markets come here and they tap my order block my order block entry here, and then I would just enter it and take it. So that's where I feel comfortable with. Sometimes the market does go through the order block like this, whatever it does, maybe some sort of form of liquidity grabs up here in these areas, and then the market starts to reverse and taps in and it starts pushing down like this. It sometimes does that, but if in this case it happens like this, what I would do is wait until the markets come back inside or below my order block, since we're in the sell in this case, and then I would wait patiently here till it taps my order block and sell here at the open of the next candle. So when the next candle opens like this, I would start selling it immediately. Okay, another thing I wanted to bring up to you guys, it's what's called refining order blocks. Now, a refining order block is essentially an order block within an order block. If you think about it, think about this as an order block here, okay? And this is an area where we look for buys. Let's say the market's going up like this. Price is pushing up, coming back here, and then going back up. Now it has to come back to an order block like this. Essentially, we're going to do what's called refining an order block. And an order block, again, like I said, it's just an order block within an order block like this. Okay. So what we're going to do is, when you're on the daily time frame, let's say this, let's say this illustration here is on the daily time frame. I'll just put a D here for daily. Okay. And we wait for the market to come all the way down here to our daily order block. Okay. What we're going to do is scale down to the lower time frame. Essentially, what I did here in this illustration, which I'll show you in a second, we're going to go down and scale down, and then find our refined order block. Okay. But we're not going to refine the order block on the entry time frame. We're going to refine it even lower. And I'm going to show you how to do that in just a second right here. So let's get out of this here. Okay, let's come over here. Okay, so here's what we did, okay? When I was showing you this whole example, refining an order block here would be, you see how the market sort of didn't really tap us in quite in, but I would have taken the trade regardless, because based off of the direction on the higher time frame, the market's pushing lows, so I would have taken it no problem because it follows my rules. Whereas we had 1 and 2 break of structures, then we waited for the market to pull back to mitigate this order block, right? So if you wanted to refine this order block right here, you would go even lower on a 30-minute, 50-minute, 1 minute, 1 minute, as I mentioned in the video, in the beginning of the video, and you would find a smaller order block inside this order block. Okay, and I'm sorry, not this one. I'm sorry. You wouldn't find an order block. You wouldn't refine this order block. Okay, when the market breaks a structure, and we know we're anticipating the market to come here and tap this major order block here on the 1 hour, we would even go lower on the lower time frame on the 1 minute here, and then look for a smaller order block that's within the structure here. So essentially, what I would do is, let's say market tapped the 1 hour order block, then now I have to wait for another 2 breaks of structure, 1, 2, and then price has to come back and mitigate up to these levels, because remember, when it needs to mitigate, you got to see the last buy before the major sell comes down, right? Or at least an area where the markets have broken structure, and then we wait for the market to come back to the last up candle, which is right here. Should be right there where the wicks are. And then now this entry down here, this entry right in here would essentially be my risk area, okay? And I could probably put that in half, do the 50% like this. Where's my tool? Right here. So I could do my 50% like this, okay? And only risk this much right here, 50% of it, right? Let's do our risk to reward tool like this. Okay. Oops, not from there, from here actually. Like that. Okay. And then essentially, I mean, look what we're targeting. We're risking only 4.3 pips on this, right? And we can target this whole area right here, because we know on a daily time frame, price is telling us it's going to go down. And look at the reward. It's 136 pips. I mean, that to me is just unbelievably amazing. See? So this is the power of refining order blocks. Okay. And of course, my theory or my liking would be to enter right when the open happens below the order block here. And that's how you would do it. So there is also such a thing as called over refining. When you over refine an order block, okay? Now, what does over refining mean? Again, let's have the scenario here. When markets are pushing up like this, and price comes down to an order block right here, and then we would scale down to lower time frames, to look for to refine this order block right there, right here. And sometimes, guys, the market comes down and it'll tap your higher time frame order block like this, and it would not even tap your refined order block. So sometimes refining or over refining an order block is dangerous, because in this case the market could just tap your order block, your major time frame order block, and start pushing price up, and you're like, oh shoot, I missed my entry. And I would say that I'm very guilty of this, because I used to do it a lot, like a lot. I would refine it all the way to the 5 second, and then I would miss my entries, and I'm like, how did that happen? So refine your order blocks responsibly, obviously, but there's different measures, there's different tactics that I take nowadays when I refine my order blocks, and so that's it. Make sure you refine your order blocks responsibly, because you can miss that trade and then you just regret you would regret it. And don't start chasing the market when you miss that order block too, by the way. Okay, if the market tapped it and went, don't start chasing, because now this is where FOMO comes in, right? And you start to fear, missing this trade, and and all of a sudden, if you start buying it, it'll come right against you. You're like, shoot, I lost it. There's a lot of this kind of stuff that happens. So you gotta, obviously trade with your emotions correctly. Not having a lot of emotions. I'm a human. I make a lot of bad choices when I trade too. But over the course of 3 years, I've been able to control them a lot better because now I'm comfortable in knowing how to trade. All right, so there's an incorrect way to trade order blocks, and I'm going to show you how some people trade order blocks incorrectly. All right, so let's just say, for example, the market is going down here, okay, and here's an area where price is starting to push up so aggressively, right? And a lot of you, or some of you, may identify this as an order block here, okay? And then obviously scale down to the lower time frame and look for buys here. Now, this is obviously wrong, right? I mean, when you scale down here, obviously you would have been probably, I don't know, look to place your risk to reward tool here, and then look for buys, and probably enter a buy, and then you see the market going against you, right? Now, just because every move in the market pushes up like this, for example, doesn't necessarily mean that an order block will be here, right? I mean, an unmitigated area would be here, and the other unmitigated areas here, and then price will come down and go up this way, right? Sometimes the market will just retrace. A lot of times the market will retrace all the way back to the real order block, and price will go off on its way, right? But a lot of people have, or some people, like I said, have the tendency to trade order blocks incorrectly, which in this case, right here, this case that I showed you was incorrect, right? You can see that the markets are pushing down on a higher time frame, on the daily, right here, right? We're going on a downtrend, and also the 1 hour is also going on a downtrend as well. So why would you be looking for buys here going up? It makes no sense, right? You want to be accurately as possible with these trades, with these order blocks. So in this case, let me go back to the daily. Trading order blocks like this is very bad, because you will lose all the time if you don't trade them correctly. Let me show you another example how you would trade an order block incorrectly. So again, same thing happens here, okay? Let's go here maybe. There's a break of structure right here, a break of structure here. Your order block is down here, of course, right? But let's say you were maybe in this area right here, okay? The markets are coming here, and you're like, okay, well, there's a huge break of structure, so I'm assuming the market's going to go up. And then you're looking for, an order block here to look for buys, right? And now let's go scale down. Let's go down here, and let's go scale all the way down until price comes down to the order block, right? Let's say price hits here, you go and it hits your order block, right? And then maybe we can wait until price actually comes back to another order block, maybe here, right, to mitigate. And let's just say you took a buy here, like this, like that, and then your target's probably your next high, let's say this high maybe. And you start buying it, and all of a sudden it makes you happy for a little bit, like this, and then price takes you out, okay? So this is the wrong way to look for buys, okay? I mean, you can also probably see here that, okay, well, market broke structure, that's correct, but just because this huge push went above this high doesn't necessarily mean our order blocks are down here and we're looking, you're looking for the market to go up, okay? So make sure you identify make sure you don't trade the wrong order blocks, because you could die in the market. So let me show you another example, okay? Prices, let's go maybe here. Let's go right here. Prices, no, not here. Where's another example? Okay. Let's go right here, okay? Price is going up here, right here. And when it's pushing up high, oh, let's not even focus on this one. Not this, this is a bad example, actually. Man, the market's so smooth here. Okay, let's pretend here. Let's look at this area right here from this area, okay? So when the markets are going up like this, okay, you're looking at an uptrend, and all of a sudden, price comes here to an order block, which is totally fine to assume that this is the order block, right? But now you're thinking to yourself, okay, well, price broke structure down here. We're still on an uptrend, okay? We're still above this low, so we should be buying, right? Say you had a break of structure here, and now you're looking for a buy here. Okay, your order blocks are right here. Okay. Let's go down scale on the lower time frame. Oops, we went so. Uh-oh. Hold on a sec, guys. Here we go. We are down here. Okay, let's go on the 1 hour. Okay. Now, here's where we are. Okay, you might have entered here, right? Aiming was high, and like I said, price keeps you a little bit happy, you know, before you know it, and then it may take you out from this area like this, right? But you know, so yeah, just stay away from the bad order blocks. Okay. Now the last one we'll talk about is unmitigated areas. Okay, and you're probably wondering yourself, like, what is an unmitigated area? Well, an unmitigated area is essentially when price does this. Let's use this. When price goes up like this and pushes high, right? And we're expecting a pullback all the way down to an order block here, but instead price does this and breaks above another high, and then breaks another high. Okay, these are unmitigated areas. Okay, an area where price hasn't come down to an order block to test an order block, you know, to push price back up. Okay, so when I refer to an unmitigated area, this is what it means. Okay, and there's sometimes you know, FOMO kicks into this to some traders, where when we're going at a, you know, when we're trading, let's say an uptrend like this, and markets are coming back down, right? We're tracing probably 50% of this huge move, but yet we're expecting a buy here at this order block, right? And say you're here, right, and market starts to reverse, you know, probably do something funky like this, you know, and then all of a sudden you're like, that's it, I'm taking a buy here because now markets haven't reached my order block, you know, and then all of a sudden market does this, and you're like, what in the world just happened? You know, so, and obviously price comes here to mitigate now, and now you're in trouble because obviously you lost this trade because you were having a fear, the FOMO kick into you, right? And the market takes you out, and then it goes on its way, right? So when I say don't chase unmitigated areas, and I mean just that, never chase an unmitigated area. Always stick to your rules, okay? Wait for the market to come back to an area to mitigate here, like this, before you take a trade, okay? Because a lot of the times your FOMO is going to kick in and you're going to start chasing the market, okay? Plan out your rules and stick to your rules only, okay? Always wait for mitigated areas. Always wait for the market to come back down to a mitigated area like this to look for the buy or sell, okay? So that's it for this weekend, guys. Okay, I hope you guys enjoy this video, and please like and comment and share this video as well with your friends and family. You know, it helps out the channel a lot, and I have more good content coming out very soon, so stick to it. Have a great weekend, guys. Thanks.